Hello, I'm Nick Britton, Head of Training at the Association of Investment Companies. Earlier today, I caught up with Ben Rogoff, Lead Manager at Polar Capital Technology Trust, to talk about his outlook for the tech sector and why investors should consider investing in a specialist technology fund.
Well, we tackle the sector with a somewhat sort of jaundiced starting point, in that many of the technology winners of yesterday proved to be very poor investments for the future. And so what we try to do is build that into a framework. We focus on key themes, and where we can establish the winners of those core themes, we'll hold big positions. And many of those are, of course, captured within the so-called FANG stocks, which, when you add the Chinese platform names like Alibaba and Tencent, can be as much as about a third of PCT today. So 8 core themes, which we build a portfolio around, with a concentration around those large-scale platforms. But in addition, there are a whole panoply of stocks that we want exposure to in the portfolio. And the way that we capture those are in sort of mid-sized positions. And many of those will be within those core 8 themes, but some of them will also be in emerging areas that maybe haven't quite made it to mainstream adoption, but where the technologies are exciting, where the market opportunities are significant. And so putting it all together, and you end up with roughly 120 stocks, which I think really reflects our view that it's much harder to understand where you've come from and therefore what not to hold, and much harder to identify beyond those FANG stocks perhaps the winners of the future. Well, I think we're blessed as tech investors to be really surrounded by emerging and exciting technologies. As a fund, we tend to focus on the technologies that are becoming mainstream, being adopted properly, but that said, we obviously keep a watchful eye on a whole bunch of emerging areas. Right now, we're very excited about the automotive opportunity for technology companies. The amount of semiconductor content per car is going up. That will increase with electric vehicles, autonomous vehicles. So we think auto is a very exciting new place. Robotics and automation in the industrial setting, also very exciting, large adjacent opportunity to technology. And our companies are really helping to rethink manufacturing in a world where demand and smartphones are changing sort of optimization of businesses in real time, and the supply side needs to catch up. So we're excited about robotics and a bunch of companies involved in the supply chain. And on top of that, of course, there are areas like virtual reality, augmented reality, 3D sensing it looks like a fascinating space. So a whole host of areas that we are keeping a watchful eye on. Well, I think the reason that we are talking about FANG stocks or FANG stocks or what have you is that these are exceptional businesses that have done exceptionally well. And we don't necessarily own all of those companies at any given time. We're not currently holders of Netflix. That's the one name I think that there's still a question mark as to how global that platform is. And as they enter new geographies, it feels like they have to invent and create new content that's expensive. It's burning cash in that process. And so it's not one we're currently involved with. The other names we are, and we like them all, albeit for somewhat different reasons. But I think the thing that obviously unites them all is scale. And I think that what we've discovered, and again I say that generically, what we've all discovered really is that the internet is a domain best played via very large companies. It's a scale game, and companies with the most nodes on their network have the most valuable networks. Well, I think as a tech investor, we're blessed with a very large canvas to invest against. And yes, there are areas that we choose not to focus on, where we feel like our input or our expertise may not have much applicability. There are also areas where we feel that new technologies are coming to undermine those. And the key area today that we believe is very difficult to invest against is enterprise computing, which was until recently, till the cloud, the dominant form of computing. And so we have a very jaundiced view of the value of incumbency, because new technologies are often designed to undermine and underprice at very much lower clearing prices for those technologies. So cloud is undermining enterprise, mobility is undermining desktop. And so we tend to try to avoid those companies. We think that they often look cheap and aren't. Other areas that we avoid, well, we don't do blue sky investing. So for all of the exciting stories you read about new technologies are going to change the world, that's possibly they are. Possibly they won't, but almost certainly they will be. Whatever they do, it will be on a different time frame than the one it first envisaged. And so this is the classic Gartner hype cycle, where very exciting new technologies are often followed by a kind of trough of disillusionment as the actual mainstream adoption timeline ends up becoming a lot longer than you'd thought. So we don't do blue sky. We don't invest in private companies. For much the same reason, but also with the added caveat that we really want to be able to change our minds. The pace of change in technology is rapid, and as investors, I think we pay a particular premium on being able to exit a position if we feel that that's no longer where we want to be.
Well, it was interesting to hear Ben's perspective on the FANG stocks, which make up about a quarter of the portfolio in Polar Capital Technology Trust, but also to hear he's got this quite diversified portfolio of about 120 stocks, enabling him to minimise the risk presented by any individual holding. Thank you for watching.